Hi everyone. I think we're probably going to start now. I think we've given a couple of minutes for everyone to dial in. So thank you very much for joining our webinar today. And as you can see, the webinar is on year-end reflections before we effectively write off 2020, given that it's been an extraordinary year for many reasons, and hopefully getting ready for a slightly more normal 2021, although it still looks like it might be partially same as 2020. Just a few housekeeping rules to start off with. A copy of the slides and the recording of this webinar will be shared on our website shortly after we finish, so maybe the next couple of days. The two presenters, myself, Adrian, and Engmin, you'll see our videos are both on. If we run into some bandwidth challenges, we may have to start switching those off, so you may see us disappear at some point. The presentation is going to take about 45 minutes. And then obviously, as with other Zoom webinars, there's a chat facility. So if you have any questions at all, feel free to include them in the chat and we will try to hopefully address them at the end. If we don't have time to address all the questions, or if it's an area that neither Engmin nor I specialize in, we'll get the appropriate specialist to come back to you after the webinar. So the agenda today is to provide you with a checklist effectively of tax considerations for you to think about as we end 2020, and obviously to prepare yourself for 2021. There are 5 areas we're going to cover in the presentation in the following order. So employment taxes, corp tax, transfer pricing, goods and services, and then some interaction between GST, CT, and TP. So to start off with.
Right, Adrian, I have 4 questions for you. The first one being, if I'm a company who has employees working overseas, are there any Singapore tax compliance requirement? What do I need to do?
Yeah, so obviously with COVID, we've had a number of clients come to us with employees who've either been stuck in Singapore or stuck outside of Singapore, as well as the traditional, having employees go overseas to work. So dealing with overseas workers first, I always ask and make sure that our clients are asked these questions to themselves. Are your people who are overseas exercising Singapore employment, and are they therefore taxable in Singapore? So Singapore being territorial, Singapore source income is subject to Singapore tax. But where an employee is exercising work overseas, so business trip in Malaysia, for instance, if it's incidental to the Singapore employment, then it remains Singapore source and subject to Singapore tax. If, on the other hand, you second them to Germany for 3 years and there's agreements in place, or the costs are borne in Germany, they're under German control, or the risks and benefit from their work go to Germany, then obviously that is not incidental to the Singapore role, and therefore that can be treated as foreign source income. The second question I always ask is, if you have non-Singapore citizens who are being posted abroad, who are leaving the country for more than 3 months, or who are leaving your company, have you made sure that you've done tax clearance properly and withheld remuneration for them before the tax clearance? If not, you may need to just double check that and backfill those obligations. There has been some COVID relief on tax clearance obligations for people working overseas, specifically those employees who have gone overseas, not intending to be there for more than 3 months, but have basically been stuck there. As long as there's no change to their employment, they're intending to come back, and it's only because of COVID, then you might be able to be exempt from the tax clearance obligations. We've helped a number of our clients just clarify this with IRS, if that's something that needs to be done. The third point is CPF. If someone is working overseas, if it's still Singapore source, as I discussed in point 1, then you still have an obligation to operate employer and employee CPF. If it isn't, so they're on a secondment, for instance, then there's actually no mandatory obligation to operate CPF. You can do it voluntarily, but the individual just won't get any tax relief. And you need to be careful what you report in your year-end forms. And then the final thing I always ask my clients is, do they know what happens in the overseas location? Just because they know in Singapore it's still taxable, doesn't mean it's not taxed in the overseas location, doesn't mean that there's no filing obligations. So something to watch out there.
Right. Okay, so on the other side of it, if let's say I'm a Singapore company who has got a number of overseas employees based in Singapore, they are here just for a short term. What do I do? What do I need to know?
Yeah, so short-term business visitors, STBVs, are a hot topic globally because nowadays with remote working and even COVID, it's very easy to travel between countries and work where you're not meant to be working, so to speak. If you've got short-term business visitors coming to Singapore, then if they're less than 60 days a year and they're not resident here, you should be able to rely on the short-term employment exemption. But if they're employed by you, you still have an obligation to report on IRA usually. But IRAS are pragmatic, so as long as you provide a letter with the details of travel, then usually that's sufficient rather than the IRA. But for those who come more than 60 days, then they aren't under the short-term exemption. So then you need to see whether they can be exempt under a double taxation agreement. If they're not, then they are taxable here. But if they are exempt under a double taxation agreement, then you need to actually make that application to IRAS. So something to consider as well. And then the final part, as we talked about tax clearance before, just remember, if you've got non-citizens as short-term business visitors and they then leave, you still need to worry about tax clearance. There is some slightly extended deadlines for tax clearance. So generally, if you've got these short-term business visitors, as long as you do it by 30th of June in the following year, or if they have an EP within 2 months of the EP expiration or 30th of June, depending on which one's earlier, then you should be fine there. And then, sorry, finally, before I'm going to ask the next question, there are some COVID-specific rules again. So if you've got Singaporeans stuck in Singapore or have come back to work remotely, as long as there's no change in their contract and COVID's the only reason they're in Singapore, then they should be okay up until 31st of December, and that date keeps moving. When I say okay, it means it's just they're not taxed on any of that income. There's a special relief for that. For non-Singaporeans, the exemption is a lot more tight. You just need to make sure that the individual meets those conditions. Broadly speaking, they have to be here less than 60 days in that trip, and none of the work in the trip relates to the business trip. And they only do it in Singapore because they're here and they have to be here. So yes, just a quick summary on that.
Right. As you're aware, companies are required to complete year-end IRA or submit remuneration details of the employees electronically via the AIS system. And this submission has to be done in early 2021. So what are the things that the companies will need to watch out for?
Yeah. So as a reminder, 1st of March is the main deadline for IRAs. And actually in early Jan, we're going to run a year-end payroll type or year-end reporting webinar as well. So if you want more information, feel free to join that. I guess whenever I'm doing health checks for my clients, the first thing I always tell them is obviously getting things right up front when they're processing the payroll is much easier than trying to deal with it at the year end. So making sure that when you set up payroll and we help clients set up their payrolls, making sure you code the different types of remuneration into whether it's ordinary wages or additional wages is important from a CPF perspective, but also when you code them, whether it's taxable and where it should be on the IRA is also important as well. We see a lot of errors in incorrect codings, and it may not sound like it's important because it may only be one payroll item, but if you've got hundreds of employees or thousands of employees, this multiplies very quickly, and therefore it can end up as quite large numbers. In terms of payroll and reporting year end, the year end reporting is not just payroll, it's all benefits. So the next question is, have you got anything which isn't running through payroll? So, if you provide them with, let's say, accommodation or personal benefits, or even if you reimburse them through payroll, do you know whether you need to report those? And taking that one further extension out, I did say Singapore is broadly territorial, but if employees are receiving benefits or remuneration from overseas or third parties, as if they relate to the Singapore employment or assignment, they are still taxed in Singapore. So we see a lot of assignees from Europe or US or APAC remain on home payrolls, and may even be still subject to 401k, Social Security, or national insurance. Some of those may still be taxed in Singapore. And the last point I wanted to make is something that unfortunately we've seen quite a lot of as a result of COVID. We've seen a number of individuals, a number of clients and companies roll out redundancy plans. And typically, as part of that, you may get your payment in lieu of notice, unpaid leave, paid leave, but you also may get some compensation for loss of office. If compensation for loss of office is purely capital that's being paid out to the employee, so it's not income in nature, then it can be exempt from Singapore tax. But clearly, IRAS has got a focus on this to make sure that it's being reported correctly. So we've seen a number of cases being taken internally by IRAS and challenged. So if you're making these payments, it's worth just making sure you've got your ducks in a row and you're comfortable with the position being taken.
Right. Quite apart from cash sort of remuneration, some companies do have stock option scheme. Some of my clients have attended the stock option webinar that is currently still on our website and found it useful. What would you say to my other clients to encourage them to watch it?
Yeah, I guess the first thing I'd say is, do you know all of the remuneration that your employees are receiving? So do you know if they're a part of any long-term incentive plans, which may include equity schemes? The reason why I say long-term incentive plans is some things I say is an equity scheme. Some things I say isn't an equity scheme, you may think is an equity scheme. So I could be talking about, deferred bonuses, cash bonuses, restricted stock units, share options, phantom schemes, stock appreciation rights. Some of those will be taxed as an equity scheme in Singapore. Some of those will not be taxed as an equity scheme in Singapore. And there's a subtle difference in terms of how you report them. And thirdly, whether they're subject to the tax clearance deemed exercise rule. So the first question is, do you know what your employees are covered by? Some equity schemes are just for the high end or the leadership team. So it might only be a handful of people. Others obviously may be rolled out to the whole office, so you're aware of those. So just making sure you're aware of them. And then the second and third question is, do you know how it's taxed in Singapore, whether it's an equity scheme or not for Singapore tax purposes? And then thirdly, do you need to do tax clearance? So that's probably, you're probably sick of me talking now. So moving on to corporate tax. I've got a few questions for Eng Min because this is not my area of specialty. And the first one relates a bit to what I do. So I see a lot of people who are displaced, and a lot of my clients don't have their board meetings in Singapore anymore because of COVID. They've had to dial in. They may even do this next year. And some of them are quite worried because they need to apply for a certificate of residence each year for treaty purposes. What would you advise, Eng Min?
Well, I think the first question I will ask is that, do you need a COR? Will you be receiving any payments from treaty countries or countries where Singapore has a treaty with in order for you to avail yourself to the reduced rate under the applicable double taxation agreement? So if you do need, then you need to understand the rules. Now, pre-COVID, currently, we look at where the control and management of the company is to ascertain whether the company is a tax resident company of Singapore. And whilst the Income Tax Act has made reference to control and management of the company, it's not defined. What constitute control and management of a company is not defined. And based on case law, reference is made to where the location of the board of the directors meeting is held. So if the board of directors meeting, the BOD meeting is held in Singapore, then this company will be considered a tax resident of Singapore, regardless of the country of incorporation. Singapore is one of those countries that disregard a place of incorporation as a condition for issuing the certificate of residence. So that's the current situation. But because of COVID, we all know that there are certain travel restrictions, especially in the early days. Now, I think you can still travel a little, but there's lots of restriction. So IRAS has actually relaxed the rules, and IRAS has actually said that if you did not, if the Singapore company have no BOD meetings in Singapore held in FY 2020, this same company would still be considered a resident of Singapore if the company was a tax resident in FY 2019 and there's no changes, there has been no changes to the economic circumstances of the company. So basically, it's still the same kind. You're still running the company in a similar manner, company doing about the same thing. And you may have some meetings held, but these meetings, like because of the travel restriction, have been held outside Singapore or, via electronic means, online meeting and all. So if you meet all these conditions, IRAS is prepared to grant you the COR, notwithstanding that there's no BOD actually held in Singapore in FY 2020. Okay, and what companies need to do is that they need to keep documentary evidence to substantiate this claim, to basically demonstrate that. It's all well and good if you look at the conditions. Now, what happens if you're a new company, i.e. you wouldn't have a precedent of holding a board of directors meeting in Singapore in FY 2019, or you're one of those company who has never held any board of directors meeting because you believe that you're already your autopilot, and come this year, it so happened that you need the COR. So what do you do then? Well, the precondition is that you must have a board of directors meeting held in Singapore. But for whatever reason, if you don't have, then maybe you can start thinking about how you can actually demonstrate to the Singapore revenue that in fact the control and management of the company is in Singapore. Now I have in practice handled cases where, because it's a huge MNC and Singapore is just one of the operation, and because the company has already been running, so it's kind of like in autopilot. So they never hold any board of directors meeting in Singapore. And then when they require the COR, IRAS actually asked quite a number of questions, never rejected them, upfront, but asked a number of questions. But the key to the IRAS's question is that, can you demonstrate that the control and management of the company is really here in Singapore? So they ask about, where are the board of directors based? What do they do when they're, do they ever come to Singapore? And what do they do there when they're in Singapore? And the people that are sitting in Singapore, what sort of roles and responsibilities they have, and what they can actually do for the company. So my message to you is that if you do need a COR and you don't have a board meetings, either in 2019 or 2020, we can still look at it and see whether you can actually, go and appeal to the IRAS as to why a COR should be given to you. It's not the end of the world yet, right? Okay.
And building on that almost, obviously I've had employees working outside Singapore due to the travel restrictions. Do I need to worry about permanent establishment risks?
Right. Actually, I have one other point to add to my earlier slide, which is, because we said that because of travel restrictions, you can't hold meetings in Singapore. So you may actually hold meetings outside of Singapore. And that relates to the next slide, which is, what happened, on the same tax resident issue, would you then have, a tax residency status somewhere outside of Singapore in the other countries? And if so, what sort of impact? I do not know. I mean, like Singapore, we are on a modified territorial basis of taxation. I can explain to you the rules and basically tell you that, being a tax resident here doesn't mean you have a tax presence here. It really depends on whether you have a source of income here. But other countries may have different rules. So on this very same point, if you have employees working outside Singapore because of the travel restrictions, say they're sitting in Malaysia or they're sitting in Indonesia, would that prolonged stay in the respective countries cause any issue to the Singapore entity? So I think that these are all in-country rules in Malaysia and in Indonesia, but it's something that you need to look into, because if it also depends on what this employee is actually doing for you in Singapore and how key this person is that if he has created a PE, does it sort of like have any profits that has to be allocated to the PE, given rise to some filing requirements overseas? So this is something that people need to look at. Over here in Singapore, the IRAS is quite kind. They actually had some rules to say that if you have overseas company, you have employees stuck here for a period of time, and it's because of COVID, they can't travel, subject to meeting certain conditions, it will not cost the overseas company to have a PE in Singapore. But a Singapore company having PE outside Singapore, if there are employees residing outside Singapore, is an issue that you will need to look at on a country by country basis, and depending on who you have overseas and what the individuals is doing for you outside of Singapore. So it's something that, most, if you do have employees working outside, you would have to really review this point to see whether it will cause any issue to your, to the Singapore company or not. Right.
Okay. And we've received a number of different subsidies and grants from the Singapore government this year. How should I be reporting these?
Right. Okay. You see, the thing is, when it comes to JSS or some of these receipts that you have, I think most of you would have received the job support scheme. It's not quite intuitive because JSS is actually given to help you keep Singapore citizen and Singapore permanent resident employed. So on the one hand, you have the wage cost where you have actually taken the deduction. On the other hand, you get the JSS as a contribution towards, the hiring of these people. Intuitively, at the start, we thought that the JSS would have been a taxable event, but the IRS has since come out to say that no, because this is actually given to you to help retain local employees or to mitigate the financial impact of COVID-19. So your JSS payout is not a taxable item. So when you do your tax provision this year, this is a happy problem. Just remember to remove it from your tax, your other income. Is not a taxable event. But there is another list of payout, which is what we normally would consider, we would be able to understand and apply the general rule, because these are those where they're actually given to you to defray your operating costs. So because they're given to you to defray your operating costs, whatever receipts that you receive from them, that receipt will be considered a taxable receipt. So basically it's a net claim lah. So if you have an expense for housing your employees, during Malaysia's MCO, you get a subsidies from the government. So the net cost is a cost to you lah, right? So there's a net expense to you. And what IRAS has done is that IRAS has provided a long list of items that will be considered taxable and non-taxable. I have actually embedded that list in the slides. So if you need to check, you just have a look at it and to see, which category, what sort of receipts that you receive and whether you'll be taxable or not lah. But top on the line, JSS is not. Okay.
Oh, good to hear. Good to hear.
Yep.
And I am looking to buy an asset, and I'm wondering whether I should defer it to next year to manage our finances, because obviously finances have been hit. What do I need to be aware of from a tax perspective before I make this decision?
Well, I think the first thing I'll ask you is that, do you really need this capital allowances claim? Will you be using it, in this financial year? I know this is the basis period. We are on a PY basis, preceding year basis. So if you really need to, there's some use of this item, then this capital allowances, then maybe it's worth the effort to basically sign on the dotted line to buy before 31st of December. Because even though you buy in that month or whatever, you get to claim the capital allowances for the full year. I'm not talking about a hire purchase. I'm talking about, an expenditure, a capital expenditure that you're going to buy, you're going to incur before the end of the year, and you would have to settle it probably next year, January or February. So there are several considerations. Number one is, do you want to claim it? Why do you want to claim it? Okay, you want to claim it because you can carry back. So that could be a considerations. And you may also know that for next year, you can actually claim your CA on an accelerated basis for those items that don't qualify for 1 year. You can either do 75% claim in YA 2021 and 25% in YA 2022. So if you do that, this is irrevocable. Once you do that, you have to claim 75-25, but that will help you accelerate the claim. So we are back to the fundamental question. Do you really need it? And do you really want it? So if you want to claim, you go ahead and claim. Then of course, if you claim and then there is a chance that you cannot fully utilize it, then the question that I will ask you is that, do you expect there to be a substantial change in the shareholders of the ultimate holding company? And will the company continue to carry on the same trade? So I think some of you will know that for unabsorbed CA, there are two conditions: same trade test, as well as no change in the substantial shareholders at the ultimate holding company level. We trace all the way to the ultimate. Okay, so if you don't expect this, then perhaps you can go ahead and claim. Even if you don't utilize this year, you can utilize it in the next year. But if you do expect a change, And you have to take note that typically we can go to the IRAS and ask for a waiver to meet the continuity of the shareholding status. But when the end from experience, the but will come later. From experience, IRAS is actually quite generous with this, and typically they will allow, you to continue to carry forward and utilize the unabsorbed items, be it losses or CA in the future, even though there's a change, if you can explain to them that the change is not tax motivated. However, there's a condition within the Income Tax Act that says that once the waiver has been granted, these losses or this capital allowances will be quarantined, i.e., it can only be set off against the income from the same trade that you carry out. So you carry on that trade, you incur some losses or you claim some CA. Now, if you need to ask for a waiver, you must continue to have income from this same trade, then you can utilize these unabsorbed items. So the condition is much more stringent. So you have to, basically consider all these points and see whether you should or should not be claiming, right?
Okay, thank you for
Okay.
that.
Yep.
So I know IRS issued a circular on designated bank accounts back in August, but I haven't had a chance to read it. Could you provide us a quick update on that?
Okay, so I think in terms of background, a designated bank account by definition means, you see, I highlighted the word solely. So it's maintained solely for the purpose of receiving trade receipts and paying trade expenses. So you can do nothing in this bank account other than to receive trade receipts and pay trade expenses. If you do any other things with this account, the status of DBA will be tainted. It will not be considered a DBA anymore prior to the announcement in August 2020. And in practice, what the IRAS actually may do is that they may actually request a bank statement to substantiate this. So they may call for like a 3 months, 1 month bank statement, ask you to go through all the ins and the outs to make sure that these are really trade receipts that you have banked in, or you're actually paying for your trade expense. Your fixed asset purchase is not there. Your loan to the a related company is not there. Non-trade items are not there. So that is the that is a very strict application of a DBA, because actually this is a concession, because by default a DBA, a bank account is a bank account, and if there's any exchange difference on that bank account, is considered to be capital in nature. So strictly, if it is a gain, not taxable; if it's a loss, not claimable. But as a concession, if you maintain it as a DBA, you get a deduction. So what happened was, I think people sort of like complained that it's almost impossible to maintain a bank account and do nothing other than receiving the trade receipts and paying the trade expenses. So IRAS listened to us, and they make the announcement in August 2020 for YA 2020. Some of you may be very early in your filing, you may have already filed it. But what IRAS has actually said now is that they are allowing a minimal amount of transaction, so-called the non-trade, receipts or expense sort of transaction to be put through. So basically, this account would still be considered a DBA, provided you have not more than 12 transactions in that account in that in that year, and then the total value of the total value of capital transactions, non-revenue transactions per annum is not more than 500,000. So if you meet the de minimis rules, then this same account will continue to be considered a DBA and be accorded the concessionary treatment, wherein the exchange loss would be considered a tax deductible item. Right?
Thank you. And I think my last corporate tax question is, I know you had a withholding tax webinar a little while ago, which is still on the website, but I haven't had a chance to review that. What did I miss from that?
Okay, I'll just do a very quick recap. I think for withholding tax, in terms of your withholding tax position, firstly, because we don't have a domestic withholding tax system, so the first question you ask is that, have you made any payment to person not known to be a resident of Singapore? I know a lot of companies would say, okay, the first cut, the difference between a resident and non-resident would be Singapore incorporated or non-Singapore incorporated company. So for non-Singapore incorporated company, right away, they're non-resident. Maybe you have to investigate further on the nature of payment to see whether there is any withholding tax on those payments. And if it's a Singapore company, you tend to conclude that it's a Singapore resident company. But as I've explained to you earlier on, a Singapore resident company does not necessarily mean that it's a Singapore resident company also. And withholding tax is an obligation on the payor and not the payee. So if you are not sure, you should ask your recipient. Okay, I mean, let's say that after you ascertain that there's a withholding tax obligation on you on that payment, if you're not sure as a payor, you have a right to ask the payee to show them two things. Show you two things typically. Firstly, they are not you know, if they say that they're resident of Singapore, then they have to show you they're resident of Singapore. If you're non-resident of Singapore, then what you need them to show you is that they do not have a permanent establishment in Singapore, because if they have a PE in Singapore, the rates would be a bit different. So you have to assess what sort of information that you need to ask from them. But of course, like I said, we need to first ascertain the nature of the payment. Is it subject to withholding tax? I mean, the obvious ones that I can tell you, interest is subject to withholding tax. If it's a royalty type payment, so it depends on whether you're paying for a copyright or copyrighted item. You know, copyright is something that you can actually exploit. Absent that, you know, you may be sued, you know, for exploiting somebody's, you know, using somebody's copyright. So, or if you are paying for a copyrighted item, you just use it for your own benefit and nothing else, then it may not be subject to the Singapore withholding tax provision. So we need to look at the nature of the payment. And then, of course, the last question that I want you to do in your year-end review is ask yourself, for those where you have actually you know, where we actually make some withholding tax payment and where you have actually accorded the treaty rate, the question that I would like to ask you is that, do you have the COR of the recipient? Now, if you don't have, you better go ask for it, because you need to file it by 31st of March next year. And if you don't submit the COR to the IRS, typically they give you a bit of time. By certain time, if you still don't submit, then they will withdraw the treaty rate and impose a domestic rate, and then impose a late payment penalty on you. So these are some of the things that you probably need to do, you know, when you review your withholding tax filing positions at year end. Right.
Okay, thank you. There's a lot of things to think about there from a corp tax side. I
Yeah.
guess from a related perspective, transfer pricing is also another hot issue which clients need to be on top of. So I've got a few questions for you, Ingmin, there as well. The first one is, what documents do I need to have to ensure compliance in Singapore?
Right. So I think we have that, the who and the what, and then the retention period here. So what documents do I need to ensure compliance? Now, not everybody needs to have transfer pricing documents. I think that's IRA's effort to make our, you know, compliance burden less onerous. So the requirement is, if you have gross revenue of more than 10 million, or if you have less than 10 million in the current year, but you have a requirement in the prior basis period to prepare transfer pricing documentation, then you need to have it. But then again, then there's a whole list of specified transactions that are exempted from TP documentation. So some of these are like, if you are trading between two Singapore companies that are at the same tax rate, or for related parties sort of transactions that's less than 15 million, or if you have I mean, just now the 15 million is the sales of goods, and then if you have got service payment of less than 1 million, then those are specified exemptions, specified transactions are exempted from TP documentation. So really, you need to look at, you know, what sort of transactions you have, and whether you need to basically prepare the transfer pricing documentation or not. And typically, I have this question to people sometimes ask me, okay, if I'm exempted from the TP documentation, does it mean that I don't do anything? I don't need to do any benchmarking or whatever, you know, for your, between the two companies, the two Singapore companies transaction. So what I would say is that the arm's length principle is embedded in the spirit of the legislation. So even though you don't need a TP documentation, I would expect, you know, some form of an arm's length rate in your transfer pricing transactions between the related company. Okay.
Okay.
After
So,
what? Yeah, sorry.
yeah, sorry. So I've got my documentation in place. Is there anything else that I need to be aware of?
Right. sorry, Adrian, can we just go back to the earlier slide? I have something else to say here. Sorry. Okay. Now, I meant to talk about contemporaneous and documentation. So what do we mean by, okay, because we talk about who needs and then what would be considered contemporaneous documentation. In the context of Singapore, the documentation be considered contemporaneous when it is available at the point of you filing your tax return. So it's 15th of December for YA 2020. Right, so that will be considered contemporaneous. And if you look at the dictionary meaning of contemporaneous, it means existing or occurring in the same period of time. So it's not quite, but it's because we're on a basis or PY basis. So by the time you do your transfer pricing doc for FY 2019 by this December of 2020, but IRAS will still consider that to be contemporaneous. And what happened is that a lot of my clients from experience would just show us this transfer pricing documentation and say that, hey, this is the one that's done in US, and therefore it should apply to us here in Singapore. I would say, no, you can't just cut and paste. You need to check whether this documentation is in line with the Singapore transfer pricing regulations. So you will need to do some localization to make the documents compliant with the Singapore TP rules. So you can't just, cut and paste from your overseas TP doc and say that, okay, you work here. And then of course the document retention period is 5 years. Same as the other documents that we need to keep for tax purposes. Right. Okay.
All right, I was too keen on the next question.
Yeah,
So
okay.
now
I'll
I know
let you
all
go
about
first.
documentation.
Yep.
What else do I need to be aware of from a transfer pricing perspective to remain compliant?
You see, the thing is, for documentation, sometimes the danger in a company is that you have all these beautiful documentations that you prepared, but actually, what happened on the ground? Does it align with what you have said in your documentation? So if you are supposed to be a limited risk distributor per the documentation, are you a reseller actually? So I think sometimes we need to really look at what exactly happened between the policy and the what actually happened actually. So we need to see that it align with the whatever interco transactions align with your group TP policy. I mean, you would think that it's a silly question to ask, but I have encountered in practice where the TP policy may say one thing, but the intercompany transaction may be priced in a different way. So, and then you can actually compare. But the easier one would be the example that I gave you there. Let's say, for example, in the case of a limited risk distributor, and if you're looking at like a 5% net margin for that distribution activities, at year end, when you close your books, it's only a 4%. You can always resolve the difference through your year end debit note, credit notes. You can basically adjust it. All right. But you will do that review between the policy that you've set and what actually happened, to make sure that your set of accounts is actually in compliance with the TP policy as well as the TP doc that you have prepared. Right. In terms of the validity of your documentation, I would say that the TP documentation, it's valid as good as long as in terms of your the business model, the setup of the company have not changed. So the functional analysis has been done. It's based on a particular setup, a particular business model. As long as that bit is still valid, then I suppose your TP documentation would still work. But if you ask me how long it is, it's actually for that 1 year. And if your situation is such that nothing has changed, the business model, the way the company is operating is the same. So you may just need to do an addendum to update it because you have actually used a different set of benchmarking from a different year. Things may change, especially now with COVID-19. Maybe, the benchmarking that you have used some time ago may not apply this time around. So you may just need to check on that. You may just need to do a TP addendum to refresh it and to make the documents valid.
And What are some of the risk areas I need to be aware of?
Okay. I think a lot of people think that, okay, as long as I have the agreement, I've got the TP study, that's it. I've got everything to support this interco charges. You know, this Singapore, this whatever charges has, whatever interco charges has been levied on the Singapore company. Now, sometimes you may have to ask for some transactional documentation from the overseas company to basically show it. For example, if you are charged some training expenses, so you may call for some like the training. Okay, this is probably pre-COVID lah. Now you can't travel. Like, like your meeting agenda, the place that you go to, your meeting minutes, some exchange of emails on that particular um, function that was supposedly performed by your overseas parent company. So you have to have some transactional data to evidence the services that's been provided for which the charges have been levied on you. So that is something that I think you should consider thinking about, how you can actually get it right. And the other few points I have on the slides are things that of late I noticed that IRAS has been asking. So sometimes they will ask you what sort of service has been provided during the year. So you fish out the agreement and say, is this? But then sometimes you must be able to sort of like evidence it. And also, it's arm's length. You will say it's arm's length, then IRAS will basically ask you, how do you ascertain that this is an arm's length charge? And that's where maybe your transfer pricing documentations would basically help you. And of late, I noticed something that the IRAS is actually looking at. I think in the technical term, I will call it duplicative service. So it's like, have these services been duplicated? What if you already have a team in Singapore doing this, why do you still need to pay your overseas entity for the same kind of service? So you must be able to explain, the differential, the incremental sort of services that have been provided to you by your overseas entity. As you all know, Section 14 of the Income Tax Act, there must be a nexus between the expense, that you have incurred and then the income that you're going to generate. So if you already have someone doing this service, or I mean, there are some absurd situation where I've seen where people actually need to pay two different related parties. So if one is already providing this service, then why would you need to pay the second one? Sometimes it's beyond the control of the Singapore company, but it's good to basically highlight all these issues to your parent company or to your related company, that whatever charges you put down on me, you better, we have to make sure that it is really for some services that have been performed. Or else, even if we have a proper transfer pricing documentation, we have all these beautiful agreements written, it may not basically substantiate what actually happened. And then IRAS may challenge, the tax deductibility of such items. Right.
And I guess with COVID-19, is there anything in particular I need to be aware of?
COVID-19. Okay, I think with COVID-19, with the travel restrictions and so on, I think the key questions you have to ask yourself is that, has there been any change to your business model? What do you do before and after? Is it the same way that you're actually carrying out your business, or is it totally different? So if you have changed, then you may have to relook at your, transfer pricing policy. Now, before COVID, for some of the companies, we're talking about profit share, profit split. Now we may be talking about a loss split, and how do you actually share that loss between the two, and how do you actually justify who is the entrepreneur, and then how these items are to be calculated. And also, and then if let's say you are the happier one, you are remunerated on a cost plus basis, limited risk, so you have limited pain, in the sharing. So if that's the case, is it still like a proper sort of margin drop to you, given that the group as a whole may have suffered? So because of these significant changes, then yeah, there will be a lot more consideration as to whether there has been a change in your business model. And then your transfer pricing study that you have you done it on a transactional level or at an entity level? Now, if you have done it on a transactional level, I guess it's easier to support because we're actually looking at the transaction and how it's impacted. And then some people have done their transfer pricing on a entity level to actually look at the company as a whole, what sort of profit you should be making. Okay, so I think there are quite a number of things that you need to relook, and then as to whether the policies are still appropriate, and whether if you do make losses because of COVID-19, can are those losses good, given whatever transfer pricing documentations that you have, and given the large number of interco transactions that you have. So you may have to be consistent also. I think if you update your policy, then the question we ask there is, how would this impact your subsequent years? So basically, consistency is very important. I mean, the whatever method that you adopt, it has to be consistent across the year by reference to the business model that you have, by reference to the functional analysis that will be done. So COVID-19 actually opened up a whole can of worms as to what has really changed and how you can actually address this. So it's something that you probably have to need to look at if your business model is really impacted. Right? Right. So I've done with the transfer pricing and the corporate tax part. I'll leave Adrian to walk us through on what you need to do for GST in terms of, why do you need to do a year-end reconciliations, Adrian? Adrian, you are on mute. Sorry.
Sorry. It's always worth doing a year-end reconciliation between your GST return and the financial statements, because clearly IRAS will have access to both of these returns, and they may not necessarily match up, and they may not match up for good reasons, but you need to understand why they don't match up and be able to tie the two numbers together. So some reasons why they may not match up is because there might be some out of scope supplies. There may be some timing differences between the financial statements, which is generally revenue recognition, and versus the GST return, which is the date of the invoice or payment. And also the financial statement, as per transfer pricing, maybe on an agency basis, and just gets commissions and reports commissions, but from a GST perspective it's actually the principal, and therefore would be reporting different numbers there. So, once you've reconciled and been able to justify all the differences, and that's great. If you can't justify them and you realize you've not reported all your supplies correctly throughout the year, then just make sure that you prepare and submit a voluntary disclosure as soon as possible. Generally speaking, if you get that in within 12 months, you can get penalty free. But obviously, if you keep making the same mistakes, then that penalty free may not be penalty free at some point.
Right. Adrian, you can talk through some of this self-assess, this kind of help that companies can get, because GST being a self-assessment system, you are self-assessing, and then you basically file based on what you think is the correct number.
Yeah, so GST in Singapore is quite unique in the way that you pay the taxes and submit the returns to IRAS. As Eamon said, it's a self-assessment system, and we all know that the government is looking to increase GST from 7% to 9% at some point. So there will be an increasing focus, although we've already started to see that increasing focus on GST, both domestically and also globally, given all the governments have spent lots of money on tackling COVID. They need to find a way of recouping all those monies. So Singapore has two options to help you, I guess, relax a bit and make sure that you're aware that you're compliant, and almost like an insurance policy to certain aspect. One of them is the ASK, and the second one is the ACAP program. So under the ASK, this is more like a health check type, almost like a due diligence process, where you review the submissions that have been done in the past. You check whether they're correct on a sample basis, and if they're not correct, then obviously you can project and extrapolate what taxes you may have over or under declared, and then make a voluntary disclosure to IRAS. And obviously, if you're making a voluntary disclosure with a GSK, with an ASK, then it's obviously looked more favourably than just a voluntary disclosure in itself. The ACAP program is a more in-depth one, so usually more complicated companies and larger scale companies would look at this. It really looks at it from a holistic perspective, looking at all the systems and controls that you have in place. So almost it's trying to test your system whether, you know, you put these inputs in, do you get the right outputs? And this is actually required in some cases. So if you're trying to get certain schemes that you might need this, and then separately, if you get this approved by IRAS, then you may be subject to less audit or less oversight from IRAS because they know you've got the correct secure systems and processes in place. So both of them are definitely worth considering if you need that additional, I guess, rubber stamp at your end.
Right. I think, Adrian, can you just quickly walk through the longer period adjustment for exam supplies? I think we are,
Yeah,
we're overshot sooner because we have 8 minutes to 11.
I know. I'll speak as quickly as I can.
Okay.
So for exempt supplies, input tax on exempt supplies aren't claimable. So you may need to exclude them from your calculations. There is a de minimis rule. So if you fall within the de minimis rule, you can claim all of your input tax, which is great. That test is done on an accounting period basis, so generally every quarter. But every year, every calendar year, every GST year, which is the end of March, you need to do a longer period adjustment or review. Most of the time, it will just reiterate the fact that all your quarters were under the de minimis, and over the year you're under the de minimis rule. But where you're not under the de minimis rule, it will reconfirm or adjust your recovery percentage for the year and rebase it for the following 4 quarters. And any adjustments that is needed over the longer period, you generally include in your Q1 GST return, which is end of June, Q1 being the GST year in that case. And the final thing is, if you have any administrative elections for reverse charge, just make sure that you elect to apply them because it's an annual election.
Right. So if I'm not registered now, what do I do?
I guess you need to check whether you need to register. There's some mandatory requirements. If you, in the 2020 calendar year, have taxable turnovers exceeding 1 million, you may need to register within 30 days, obviously, as it says there. Or if you think you're going to hit the 1 million in the next year or the next 12 months, so it's not necessarily a calendar year, then you may also need to register. There's 2 more recent ones to do with reverse charge. So if you procure services from overseas suppliers and they're exceeding the 1 million, then you're not entitled to full input tax. If you were GST registered, then you need to consider or make sure you have that registration. And then finally, there's an overseas vendor registration if you meet that one. So if you are an overseas supplier or even a local electronic marketplace operator, just make sure whether you need to file and register under those. So as the slide says, if you need to register, just make sure you've got the necessary processes set up to facilitate GST returns. So I guess the last few slides that we have is to do with TP adjustments. So if as Angmin's talked about, if there's a TP adjustment required by once you look at it at year end, do you need to consider GST and corporate tax? So GST, they've come out with a circular recently. Basically, if there is an adjustment, you need to consider GST unless there's an admin concession. So as it says on the slide there, if there's a overseas adjustment, a TP adjustment, you need to do a GST adjustment. And if there's a local TP adjustment, then you also need to do a GST adjustment, and it gives you a bit more detail over how those are made. The admin concession, in summary, if a GST adjustment does not impact the total GST that's needed to be paid to IRAS, because either the input and output batches, then you actually don't need to make that GST adjustment. So we've outlined the 3 scenarios which this may be the case, but it's worth just checking if you have TP adjustments whether you meet these concessions or not.
Okay, so if you made the TP adjustment, then I think following on from what the GST bit that Adrian has discussed, we need to ask ourselves, is it an upward or a downward adjustment? So upward meaning to say you increase your revenue or you decrease your cost. So in this case, for tax purposes, this will be tax. And then if it's a downward adjustment, and Singapore is one of those few countries that actually allow downward adjustments, so you actually decrease revenue or increase your cost, then you only allow if you meet the three conditions. You must have in place contemporaneous TP documentation to support the arm's length price, and then the adjustment has to be symmetrically made in accounts of related parties. So IRAS don't want a double non-deduction or non-taxation, a double deduction of these same items, and then you have to do your adjustments before you file your tax returns for your downward adjustments, right? So, right, we have come to the end of our presentation. I think, Adrian, we have one question in the Q&A chat box, which I think I can quickly address. So I think the question is, the company is exempted to prepare TP doc. So they did one TP doc a couple of years back, no change to the markup rate, business model, and nature since then. Do we need to do a TP doc every year? So I think I can say that no change to your business model, I can understand. No change to the nature of the business, I can understand. As to whether you need to change the markup rate or not, I don't know. So I think you may need to just refresh it on that basis. So if everything else is the same, then you want to do it as, just to basically prepare for yourself for any queries, even though you may be exempted, then I would say you can do a TP addendum to just make sure that whatever rates that you use as a markup is still valid. Okay. Okay, I think I have a question that asks, for downward adjustment, can we go back and revise the previously filed tax returns? I think it's a bit more difficult because you have to put it through in the returns that you file. Before you file your tax returns, you have to put through your downward adjustment. So you wouldn't have met these conditions. Right. Do we have any other questions?
If we've got no other questions, well, if you've got any other questions which you want to ask, feel free to contact us afterwards, and we can either provide the answer or find one of the specialists to help provide the answer. Otherwise, as I said at the start, so you may have missed it if you joined late, a recording of the webinar and also the copy of the slides will be uploaded to our website in the next few days. So if you've missed anything or didn't quite catch what we said, feel free to rewatch it or download the slides and for example, access the PDF that Engmin's embedded into the slides as well. So other than that, thank you very much for attending.
Thank you and have a nice day.